traders, and happy Volatility Day to all those who are interested in volatility. Brian, how are you doing this morning?
Well, markets obviously down a little whippy coming into Sunday. Inflation numbers out of China a little bit lower than expectations, so that's kind of setting the tone here early. That at least said it's Sunday night, and markets are they're whippy, Joe. They're whippy.
Yeah, we're seeing volatility in a big way. There's no question about that. I want to talk about volatility today in a big way, Brian. I want to talk about why we can expect to see more volatility going forward in 2025 and how to trade it and really how to put it in a portfolio altogether. Stick around to the end of the show. We're going to trade on the market broadly. I got a trade for a SPY, but just you can look at that as Q is very similar. S&P 500 is the big one, the E-mini. You can look at that too. But yeah, I got a trade for the SPY. Stick around in the show. I think that will be really entertaining. So anything else going on with you this weekend, Brian, before we get into this?
Yeah, I think when we get into the trades here, obviously volatility is on everybody's forefront here. The VIX mid 20s, so that's certainly a concern. Market feeling like there's still a lot of uncertainty. There's still going to be a lot of volatility going forward. We're heading towards the end of the quarter, so where options are trading are going to be a big thing that we're going to continue to talk about over the next couple of weeks here. That's something to pay attention to, big strike prices with open interest as we hit the end of the quarter. But Joe, we've always talked about March being the most volatile time in the markets on a seasonal basis, and certainly we're getting that again.
Yeah, we're certainly getting it. Let's get into the trades as we go through here, and let's get into the show also. Definitely seeing some markets in turmoil. Cue the music, Brian. Yeah, we're dropping today. We dropped last week. We're below the 200-day moving average. That's really critical. And there's a lot going on around the world. I will say there are some, bright spots still in the market, but maybe this is just kind of the sign of the economy slowing down and the market's starting to roll over.
Yeah, well, and speaking of turmoil, a lot of turmoil coming from Bitcoin, Joe. That Bitcoin down to 80,000 overnight. It's been a concern. It's actually almost been a market leader for whatever reason. And despite the government announcing Bitcoin reserves as being a thing for them, I don't know. Like, to me, it seems that adding a digital currency as a reserve currency holding, what's the end game there? There are thousands of different coins out there, and to me, it seems like they're all going to zero, if I'm going to be frankly honest.
Yeah, that's a great point. I think there was a lot of hype around that announcement, and it just kind of seemed like a dud. They're maybe looking into it, or we're going to see what actually comes out of it. There's no guarantee it'll even be Bitcoin, Brian. There's no guarantee it'll be additional purchases. The U.S. government already owns a lot of Bitcoin from assets they've seized. So there's just a lot of uncertainty. And of course, you also mentioned the global growth slowdown. Like, Bitcoin's kind of a risk-off trade too. See it lower. You also mentioned deflation from China. It's a lot of news hitting Bitcoin, and it just kind of is weighing on the market broadly. Just a lot of negative news for sure. We also got Brian. We got Ukraine still in the news. This big area of uncertainty. I think this would be fantastic if a deal would be happening, but it just kind of seems like there's going to be more fighting for me. I'm not sure what you're seeing.
Well, I do think actually they're going to slowly come to an agreement. The end game really is the fact that wherever it's left off, you have two enemies sitting at the border with each other, no matter what that border is. And at some point, tensions will bubble again, and there'll be issues. And things don't get resolved that easily when you have two enemies, like I said, sitting at the border with each other. I do think, though, that both sides are getting a little tired, and I think both sides are willing to listen to what the U.S. has to say, and that in itself may create some sort of peace deal. So I do think we are, I think we're nearing some sort of at least pause in the fighting that's occurring. and maybe, sides can get along for a little while.
Well, let's hope you're right there. I'd love to see that. We're also seeing a rally out of the treasuries.
Yeah.
People were saying this is going to be good if we're going to see these 10 years slipping, but we don't want to see it slipping with the economy falling too, Brian. So that's kind of the problem, the double whammy we have going on here.
Yeah, well, we're seeing the 10-year now today. I'm just looking over here at my screen, 4.22 on the 10-year note. That's down 8 basis points. The 2-year down 8 basis points as well. The 2 10s that so many people look at for inversion is still sitting around 30 basis points between the two. So that's sort of interesting that all rates are kind of coming down together. So to me, yeah, that's like to your point, is there a concern that these rates are coming down, that the slowdown in the economy is coming, and that's why all rates are headed lower?
Yeah, I mean, there's just a lot of uncertainty. The spending bill is coming up too. This is going to be really important. And I don't think a lot of people are talking about this. Is going to be this week. There needs to be a spending bill to avert a government shutdown. So we'll see what happens. I think the market's optimistic that something will happen, but until it does happen, nothing is there.
Yeah, typically though, when this does get resolved, there is some sort of relief rally and volatility comes off its highs. So this will be a story to watch. I'm glad you brought this up, because this is something that if we can sort of get some resolution here, this might relieve some of the pressure from everything that's going on in the tariff situation. And then more importantly, tariffs by Trump, we just need clarity. Like, they're on again, they're off again, they're partial, they're going to tariff this, they're going to tariff that. No, they're not going to do it. And all that wishy-washy is raising volatility in the marketplace. So I think you need two things to happen: the budget to be passed here, and some figuring out of maybe down the road, 6 months from now, what the tax situation is going to look like. If that's going to be the next sort of thing that Congress tackles after they get this budget passed, are they going to start looking ahead to the tax situation? And then, the tariffs, just getting more clarity. I think that will all relief.
That's supposed to be in this bill, Brian. The tax cuts, the deregulation, this is the one omnibus bill that the ruling party usually has been able to get their whole agenda through, their whole mandate. It's all supposed to be in this one. All the other bills are going to require, a filibuster-proof Senate. So this is their one shot to do what they want to do.
Right. So if it all can get done right here, then you may see a pretty big rally, considering how far we've sold off from the highs.
Well, that is certainly true. And I think you're talking about what usually happens here. I think that what usually happens in this current administration, I think we should think twice, though. I think this is a different administration. This is not usual. So I think the market's putting a little bit more juice into the pre-volatility than they normally would, because this is just not a usual administration. It's not a usual Congress. So the market's just anticipating, hey, anything can happen. Maybe they're going to miss this by a week or so or less, and we could have some more uncertainty before ultimately pushing something through.
Well, I'm anxious to talk about volatility in our big picture here on the show, Joe. Do you got any more headlines here? Or it seems like there probably should be more headlines. It seems like there's a new headline every 30 minutes when the market's open. But what else you got?
That's all I got.
All right.
You ready to get into the volatility?
Yeah, let's do that.
All right. So let's take a look at the skew. We've been looking at this for a while. Remember, the skew measures a 25 delta put versus the 25 delta call in the S&P 500. Typically we see this wavering, and this is often kind of a leading indicator for the VIX and volatility for us. We like to have a handle on where volatility is going. Everybody would. And right now, this is just trending higher. It was interesting last week when the market was making fresh lows. This kind of was stubbornly sticking around there, really not giving a great clue to ways. If we did see a lower low last week, Brian, I would have said, hey, the market's getting ready for a bounce here. But since it kind of was like neither higher nor lower last week, said to me that maybe the market's still looking for a bottom here.
Yeah, I thought the market was going down midweek and even into the end of the week, and the skew was not going up. Like, we did not see a lot of right in there. We did not see a lot of put buyers come in where there was some sort of panic to the downside. So I thought we would get a rally. We hung in there, but as Friday sort of kind of took its toll And now today we're seeing it. It just really hasn't manifested into the amount of call buyers like we would like to see, where the skew does come down. And now we're shooting up, and it almost looks like this is like a little double breakout right there. That's a key level that maybe sends the skew even significantly higher and people into a tizzy and a panic. We haven't gotten VIX 30 yet. Looking over here on my screen, VIX at 26.5. Maybe VIX 30 is in the cards. The skew's got to get above 10, and there's this sort of washout to get this bottoming process. But this will be something to watch to see if call buyers can come in and take the skew back down as sort of a leading indicator that the market's ready to turn back up again.
Yeah, I mean, for me last week, I would have loved to see like a rally in the stock market plus the skew coming below here for me to feel like an all clear for skew. Now that we're up here, this is obviously a critical area here around this little under 8 here. But for me to get an all clear, I need to have a below this level here. So that's what I'll be looking for, just a definitive break that this thing is coming back lower. To watch out. That said, we called it right last week, Brian. We had our volatility on, our signal was staying on, and that nailed it. We're just kind of waiting for the turn here as we turn around.
Yeah, that's right. Our volatility skew, our signal is on. And let's just take a look at this VIX term structure. You can see VIX futures, the VIX trading higher than the futures market, the entire curve trading higher than it was last week, where it was last month, where it was 2 months ago. So the uptick in volatility is being felt, as being prevalent. Our models still say to hold on to some of this here. Looking back, where could it go if sort of we get a rally and volatility comes off? I kind of look at a mean reversion, maybe around 19 or so, where I'd want to maybe re-engage and pick up some more VIX, but I'm not taking it off yet. So I'm not even really looking for levels for it to buy. I think there still could be some room from a structural standpoint in this market that takes it higher. And people obviously looking out all the way till April or May, and that's still trading above 21, right? So there's a lot of skittishness in the market.
Yeah. So obviously a lot to point out here. We got this, backwardation formation here in the VIX futures, a big gap here between the cash and where the spot front or the spot cash in the front month is. So that's very fascinating. This is going to be a lot of volatility here over the next little week or so as we go into expiration here. So there is a big potential here for volatility in this front month. Obviously they're expecting a pullback in the spot, but we'll see. Now, that said, talking about this backwardation, these are very elevated futures, and it's just the market just out there saying, hey, volatility, we know we got some short-term events, yes, but volatility is going to remain high for the foreseeable future. I think if we get a resolution in the budget deal, I think that'd be the best thing for the market, because then we'll have a lot more certainty. But then we still got to deal with tariffs on an ongoing basis. So I think that would be the next thing. But a resolution of that budget deal would be so big for me, because we know what the deregulations are going to be. We know what the tax cuts are going to be. The market has that certainty. I think volatility will come down a big way if that happens. And then, people can put their money to work where appropriate, where the budget is more friendly to those sectors or those specific stocks.
I think what's interesting about the VIX futures curve, though, just one last thing to sort of button things up. The reason why VIX futures maybe on the back end are so much of a discount to VIX itself is, remember, these VIX futures are tied to the next month out S&P options, which are trading at a very high discount to where the weeklies or daily options are trading at in terms of implied volatility. So there's this big gap. The VIX futures are sort of discounted down with the rest of the S&P implied volatilities. I actually think that poses some opportunities for traders to buy, let's call it, April options, May options, and sell weekly options against that. But you got to be a little bit, you got to be trading around your straddle. Let's say you bought in the back month, and systematically leg into some of this like weekly elevated implied volatility. And that's why you're getting this steepness in the curve.
Yeah, so it makes a ton of sense if you got the retail people, retail traders trading this market, buying the 0 days to expiration options, bidding up that volatility on the short term, and the market makers just saying, okay, you want to pay for it, you're going to pay a higher price. I think that makes a lot of sense that kind of fits with what we're seeing.
Well, but I think that's why the back month implied volatility on the S&P needs to be higher. I mean, I think it's not higher because so many people have played such a premium on the weeklies. They're going to get their sort of realized implied sort of volatility trade out of the weeklies or dailies that it's suppressing the back months, I think, unusually low. I get it that volatility could come off and come down, but if we're getting over 1% daily moves in the market, these back months should be higher. I think that's why our model really is kind of saying, let's stay long these VIX futures here because there's some room for them to pop higher, I think, because I just think the back months are too cheap.
Yeah, 100%. Kind of going over what we've been talking about, Brian. It's exactly with the market here. Yeah, I mean, there's a lot of uncertainty. There's a lot of I think also we just kind of need to put it in perspective too. We had a very high PE, off of this high in the S&P 500. With a modest slowdown in the economy, it just makes sense that stocks need to have just a little small pullback here. And it doesn't necessarily mean that the rally is definitively over. And just because we are below the 200-day moving average doesn't mean it's completely over. But it absolutely is a risk. It has to be absolutely something we need to be watching here.
Yeah, that's a lot of headline news to be looking at, and that is justifiable that you see a VIX in the mid-20s with all that news and uncertainty on the table.
So what do you think? Should we get into our trade of the week here, Brian?
Yeah, I mean, I think as we look at the trade of the week, we wanted to dissect sort of an options trade around the S&P, around the NASDAQ, something that's a big market mover kind of thing. Looking here at the S&P 500, here's a one-year chart. You can kind of see this topping formation, the breakdown of going through support. And you talked about the 200-day moving average. Now we're below the 200-day moving average. Is this going to trigger a bear market, Joe, or is the market a little bit oversold and ready for a bounce?
When they say you have a slowing economy or into a recession, cash is king. And that makes a lot of sense to me. But actually, I think I got a trade that's better than holding cash, Brian. It's kind of going to be holding cash, but also I want to own the market if it goes higher. I mean, shocker, who wouldn't want to own that? And I want to buy the market not at this level, but much lower. I mean, shocker, who would want to own that? And that's kind of the point of holding cash is you'd rather buy it lower. But the risk of holding cash, of course, is that it's going to turn around in a dime. You're going to miss the uptrend. So I'm just looking at this chart here. I see we're below the 200-day moving average. That's a big concern for me. I don't necessarily want to own any stocks below this 200-day moving average. So I'm going to design my trade around that. I'm also looking at this 50-day moving average. Given where we are right now, I don't see us trading above this 50-day moving average here, Brian, before the end of the month. I don't think we need to worry about the stocks coming up here by the end of March, but I do think that's certainly possible. We could turn around, be above this 200-day moving average, and I kind of think when we get back above this 200-day, it often just rides to this 50-day and then stalls. So that's where I'd be designing the first leg of my trade. Then to do it all premium neutral, I can sell a downside put. I'm actually looking in the SPY, Brian. Very similar action here. I'm just looking at the SPY. 571, 585 call spread, selling the 555 put. Very close to where the 200-day moving averages are. Maybe the 50-day moving average is slightly lower than 585, but that's how I'm designing that call spread. Selling that 555 put to allow me to collect some premium. It's going to be a little bit more right now looking at this trade as it's lined up. But this allows me to buy the SPY at 555, lower than 2%, about 2% lower than where we are now, which to me is very reasonable over the next 2 weeks here to be looking at that. And then to get that call spread where I get that upside exposure, if we snap back above that 200-day moving average, I think we can get back all the way up to 585.
Yeah, just to make a little correction on the price, the SPY is at 566 right now, not 346. But you're looking at a SPY 566, right? and you're buying this call, this March end of the month call, 571. So we need a $5 rally in the SPY. That's about 1%, right? Once we get up 1%, the trade would participate all the way up to that 585 level, which I love the technical structure of it, where you're using moving averages sort of to determine your strikes. And then the downside put that you're selling, if I were to do it, I would be okay going a few strikes lower even and having to pay a little bit here. I know that this trade structure is such that Joe is actually not outlaying any capital. So that means nothing happens until the SPY goes below that put strike, that 555 put strike level. So I would have money set aside, by the way, to buy the market if it gets down there. So that's something to think about, that this is somewhat of, if you were just to put this on without any sort of cash covering, there would be some sort of leverage on that. So I'd have the cash set aside, $555, or in this case, one option contract's 100 shares, so $5,500 set aside. And if I want to pay a little bit for this trade, I can move that short put strike down a few handles on the strike price there. But I do like this trade because it's a way of sort of selling volatility, because you're selling the outside wings and then recognizing that the middle is going to have right now, the movement in the market is right now, and that long call strike would allow you to participate to the upside.
Yeah, so it looks like my 555 is right about in this level if you're comparing it to the SPX. I can see your point, maybe a little lower in this area would be a spot too, but this would be an area where are targeting on a sell-off to reinitiate, and I'm very comfortable doing so. I'd much rather be in cash than down 2%, holding the stocks while we do that. So that's the first part of it. But then again, yeah, I think the critical thing is I can't really time this turnaround, but I can say historically, when I've seen the market jump back above the 200-day moving average after it's been like definitively below it, likes to bounce back to that 50-day.
Yeah. And by the way, if you're really worried about the market, you could buy I've talked about maybe a May or April straddle. If you really want to extra added extreme volatility hedge, this is for maybe the more sophisticated kind of trader. But I would maybe look to buy an April or May straddle against that, knowing that straddle protects me against that short put that I have on, where I'm going to be put to the market. I could kind of cancel that out with the straddle. That might be sort of an interesting trade, and I can kind of trade the straddle back and forth in the gamut to that if I'm a more sophisticated kind of guy. But so I like those two kind of like in conjunction to each other. But certainly this trade as a standalone is a good way to sort of dip in if you're thinking, hey, I should maybe think about putting some cash to work here with the VIX at in the mid 20s. That it's maybe about time to buy the market. Although we said, we talked about the skew earlier in the show. It hasn't signaled a total buy signal, and this is why this is sort of a cautionary. Keep cash aside, pick some strikes lower because you can't find the bottom. The indicators aren't saying we're ready to rally yet, but this is a bullish trade, so be aware of that. So that's why you can kind of, work into this. I don't need to if I miss the market a little bit, I think there'll be opportunity to get it again.
Yeah, 100%. I think that was pretty much covers that trade. It's just works for me. I'd rather be in cash right now than in the S&P 500. If I were in the S&P 500, I'd miss 1% or 1.5% to the upside. I'm okay with that. I'm okay with being on the sidelines for that little bit. I want to be in it if we are above this 200-day moving average. I don't need to be in it down here. We can think about those put strikes where we were to get long again. But if we do end up being put to the SPY below 555, we can just turn around, sell a call against it, collect some more premium, just lowering that the cost of the trade.
Yeah, well, that about wraps it up. If you like our trades here, make sure you tune in every week as we can continue to do this. You can also go to equityarmorinvestments.com and subscribe to our trading programs. We have 3 of them there. If you do that, we continue to update these trades. We send that trade alert directly to your inbox. You can trade off of that. So that's something exciting we're willing to offer here. There's also going to be coming out this week a link to connect. If you open up a Tradier account and fund that account, you actually get 4 months and all 3 of our trade strategies for free. So that's kind of an exciting little deal that we have giving to you. So make sure you tune in every week here as we give more market insight, more volatility to come. So pay attention here on the Trading Zone. I'm Brian Stutland here of Equity Armor Investments. With
I'm Joe Teague, Equity Armor Investments. Sorry for jumping on you.
All right, we'll catch you guys.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer.